Hey everyone! In this video, we're going to show you a powerful and effective trendline trading strategy that you can start using right away. Make sure to subscribe and hit the notification bell so you never miss out on our latest trading tips and strategies. Let's get started. What is a trend line? A trend line is a visual guide used to connect key points in a market that's moving in a certain direction. In an upward moving market, you'll notice a pattern of strong upward movements followed by smaller pullbacks. These are known as impulsive and corrective phases. Each peak that forms before the price starts to pull back is called a swing high, while each low that forms before the price moves up again is called a swing low. So, during an uptrend, price typically forms higher highs and higher lows. To draw a trend line, you connect the swing lows underneath the price to outline support, or the swing highs above the price to outline resistance. In a downward moving market, you'll notice a pattern of strong downward movements followed by smaller upward pullbacks. These are known as impulsive and corrective phases. Each low that forms before the price pulls back upward is called a swing low, while each high that forms before the price drops, again is called a swing high. So, during a downtrend, price typically forms lower highs and lower lows. To draw a trend line, you connect the swing highs above the price to outline resistance, or the swing lows below the price to outline support. The reason why we draw trend lines is to visualize the direction of the market and make better trading decisions. The first thing is that they act as dynamic support or resistance, showing areas where price might bounce, reject, or consolidate. The second thing is that when a trend line is broken, after being respected multiple times, it can signal a possible trend reversal or a change in momentum. The third thing is that they help us follow the trend, making it easier to avoid emotional trades and focus on high-probability setups. One important thing to remember is that trend lines are not exact lines where price must touch. They are areas where price might react or reject. So don't expect price to respect them perfectly. Always give some room around the trend line because price can get close, bounce off slightly before or after it, or even fake out before moving in the expected direction. Now that you understand what trend lines are and how to draw them, let's move on to how we can use them effectively alongside price action. There are two main ways to combine trend lines with price action: the trend continuation strategy and the reversal strategy. Let's begin with the trend continuation approach. We'll break this down step by step using a single time frame for simplicity. Step number 1. It's clear that the market is in an uptrend. We can see this by observing the formation of higher highs and higher lows. In this case, we want to align our trades with the prevailing uptrend. Step 2. We draw our trend line by connecting at least 2 or more swing lows. Extend the line forward so it can act as a potential support area if the price pulls back. Step 3. Looking to the left of the chart, we spot a fair value gap inside a resistance. Now this resistance turned into a support. We mark this zone on the chart. Step 4. We identify a key level where the trend line intersects with the horizontal support zone. This intersection forms what's often called a confluence area point, where multiple technical factors align. These areas tend to attract attention from traders and often provide high-probability trade setups. We will not enter a long trade immediately when the price reaches key levels. No matter how strong an area appears, we never enter trades blindly. We always wait for clear price action signals, because price can easily break downward and reverse the trend direction. In this case, the price was rejected by a small green candle, which makes buying risky due to the lack of bullish momentum. It's best to wait for further confirmation. Zooming into the lower time frames can provide better insight. On the 15-minute chart, we can identify a small downward trend. As mentioned earlier, a trend line is not just a single line, but rather an area where price may react. Price has broken above this short-term trend line, which could indicate a potential buying opportunity. Currently, we have several confirmations: a fair value gap, A resistance level that has turned into support. A bounce off the long-term trend line. A breakout above the minor downward trend line. With all these confirmations in place, the long position now has a high probability of success. In another example, we look for a specific setup where the trend line and resistance or support come together at one point. This point is what we call an area of high confluence, a place where different traders are ready to take positions. Let's break it down clearly. Imagine a market situation where we had a support level that used to push price higher. Once that level is broken, it turns into resistance, stopping price from moving up again. At this level, different traders are using different methods. Some are focused on the resistance. Others are trading based on trend lines. Some are watching candlestick behavior. But we don't rely on just one thing. We wait for all of these to align. That's where we take interest. When resistance, trend line, and candlestick behavior come together, it gives us higher confidence. That level becomes more significant because different strategies point to the same area. Now, the market is in a downtrend, so we're only interested in selling opportunities. First, we draw our trend line. Then we identify a support level that was broken and is now acting as resistance. These two meet, forming the area we care about. As price approaches that level, we see rejection. Multiple candles trying to break through but failing. This gives us a clue that buyers are weakening. Now, we draw a mini trend line following the short-term bullish move. If the price breaks that mini trend line, it tells us the bullish correction is over, and the bearish trend is likely to continue. That's when we look to enter a short position. The bigger picture is bearish, but the short-term movement is confusing. The mini trend line helps filter that noise. If it breaks, the direction is clear again. So, to wrap things up, trend lines aren't just tools. They're a way to visually feel the market's momentum. Whether it's ascending, descending, or even flat, each type tells a different story. The better you get at drawing and trusting them, the more clarity you'll have in uncertain markets. If you learned something new today, give this video a like. It lets me know this content helps. And if you're into clear, no-fluff trading breakdowns, go ahead and subscribe. I drop videos regularly that go straight to the point. No time wasted. Got a question about trend lines, or want me to cover something specific? Drop it in the comments. I read them all. Thanks for spending a few minutes with me. And as always, stay sharp and trade smart. Catch you in the next one.